The Federal Reserve is tasked with keeping the U.S. economy stable. One of its main tools is the federal funds rate. This rate influences borrowing costs for individuals and businesses. Recently, the Fed has been cutting rates to stimulate the economy. However, something unusual is happening. Treasury yields, which usually fall when the Fed cuts rates, are rising. This unexpected trend has surprised many economists and investors. It signals a potential disconnect between the Fed's actions and market expectations. This situation creates a dilemma for the Fed. Lowering rates too aggressively could fuel inflation, but not doing enough could hinder economic growth. The Fed must carefully balance these risks as it navigates this complex economic landscape. Historically, Treasury yields and the federal funds rate have moved in the same direction. When the Fed cuts rates, yields usually follow suit. This correlation is rooted in the basic principles of supply and demand. Lower interest rates make borrowing cheaper, encouraging businesses and consumers to spend more. This increased demand for goods and services can lead to inflation. To combat this, investors often demand higher yields on long-term Treasury bonds as compensation for the erosion of their purchasing power due to inflation. However, the current situation defies this historical pattern. Despite the Fed's rate cuts, Treasury yields are climbing. This suggests that other factors are at play, overriding the traditional relationship between Fed policy and bond market behavior. One possible explanation for rising Treasury yields is market expectations. Investors may believe that the economy is stronger than it appears. They might be anticipating higher inflation in the future. If investors expect the economy to grow, they may demand higher yields on Treasury bonds. This is because they see better investment opportunities elsewhere. Higher growth often leads to higher interest rates, making bonds less attractive. Furthermore, if investors anticipate higher inflation, they will demand higher yields to offset the erosion of their returns. This expectation of rising inflation can push Treasury yields upward, even as the Fed tries to stimulate the economy. Several factors suggest that the U.S. economy is performing well. Unemployment is low, and consumer spending remains strong. These positive indicators contribute to the upward pressure on Treasury yields. Strong economic data often translates into higher inflation. When more people have jobs and are spending money, demand for goods and services increases. This increased demand can lead to price hikes, fueling inflation. Investors recognize these inflationary pressures. They demand higher yields on Treasury bonds to protect their investments from being eroded by inflation. This demand for higher returns further contributes to the upward trajectory of Treasury yields. The policies of the new administration are also playing a role in shaping market expectations and influencing Treasury yields. President-elect Trump's proposed tax cuts and increased infrastructure spending have the potential to stimulate the economy, but they also come with risks. Tax cuts can boost economic growth in the short term. However, they can also lead to larger budget deficits and potentially higher inflation in the long run. Investors are wary of these long-term risks and demand higher yields on Treasury bonds to compensate for them. Increased infrastructure spending can create jobs and boost economic activity, but it also increases government borrowing. This increased borrowing can push up interest rates, including Treasury yields, as the government competes with other borrowers for capital. The Federal Reserve faces a challenging environment. The traditional relationship between Fed policy and Treasury yields appears to have broken down. This makes it more difficult for the Fed to manage the economy. The Fed must carefully assess the various factors driving Treasury yields. These include market expectations, economic growth, and government policy. Based on its assessment, the Fed will need to adjust its monetary policy accordingly. If the Fed believes that the rise in Treasury yields is due to stronger economic growth and manageable inflation, it may continue to gradually raise interest rates. However, if the Fed fears that rising yields could stifle economic growth, it may choose to slow down or even reverse its rate hikes. The Fed's decisions in the coming months will have significant implications for the U.S. economy. Finding the right balance between supporting growth and controlling inflation will be crucial for maintaining economic stability.